Learning objective 18-9 is to make calculations and record journal entries for the trust funds. So first of all, let's talk about what fiduciary funds are. We have fiduciary funds with a third category of funds. We had governmental funds, proprietary funds, and fiduciary funds. And there's two types of fiduciary funds, what we call trust funds and agency funds. Agency funds will be the next section. So next fund, trust funds, will be pensions, investment trust funds, and private purpose trust funds. All employee benefits are included in employee retirement benefit funds, that is, are going to be considered to be pension trust funds. So what trust funds do is they account for resources that are held by the government in some kind of trustee capacity. And that's really what's key here to it being a trust fund, is that the government is considered to be a trustee. And it has a fiduciary responsibility for these monies, and they're supposed to do with them, they're legally whatever the law says they're supposed to do with them. They have a certain responsibility for them. So this could be on behalf of employees, other individuals, even other governmental agencies. But what makes it a trust fund is this trustee responsibility towards it. They use the accrual basis of accounting, and they're going to have two financial statements. The fiduciary statement of fiduciary net position, which is a lot like a balance sheet. And the statement of changes in fiduciary net position, which is a lot like an income statement. It's not called that, but it's like an income statement, or what I like to call the P&L. And the statement of changes in fiduciary net position includes only trust funds, because agency funds are not going to have a net asset balance at all. So they're not really going to have, they're not supposed to show any income. And just as an aside, a private purpose trust fund would be a situation where the principal or the income statement is limited to specific individuals, private organizations, or other governments. And the benefit, therefore, is limited to private rather than general public purposes. And that's how this is a private purpose trust fund is different from, let's say, a permanent fund. So Salt City receives a donation of $50,000, and this is for senior citizen transportation. The story is there was a woman, and she had transportation for the city for many, many years, and when she gave up her life, when she was 100 years old and she finally didn't hold on anymore, she donated $50,000 to Salt City so they would have money for senior citizen transportation, because that was very meaningful to her. So they can spend $25,000 a year of this money on senior citizen transportation. And the city takes $25,000 and puts it into highly rated bonds. The other $25,000 puts it into the bank. And the city is allowed to take $1,000 a year as an administrative deduction. Transportation costs paid in 2012 were $20,000. So when the city receives this donation, it's going to debit cash, and it's going to credit additions, contributions. And that will be a revenue account. I'm sorry, it's a man, Charles Alt. So you didn't go into the, because we didn't do partnerships. Charles Alt is a character in some of the intervening chapters that we've managed to skip. So chapters, I think 14, 15, 16, they give you the story of Charles Alt. Charles Alt made it big in partnerships. Just so you know. So they're going to invest $25,000 of Charles Alt's money in bonds. And I guess here in chapter 18, he dies, and he gives $50,000 to the city. But he made the money in like chapter 15 or 16. I don't remember which one. So city invests half of the trust fund in bonds, $25,000, record investment in bonds. And then earns $600 interest, debit cash, $600, credit, additions, interest, $600. And then they go and they pay $23,000 for transportation. The journal entry would be to debit deductions, transportation benefits. I like how they call expenses benefits. We should do that. Benefits. It's not an expense, it's a benefit. So administrative, in fact, expenses should give benefits, right? You shouldn't spend money on things unless they provide some benefit and bring in some revenues. But that's besides the point. I just like the term transportation benefit rather than transportation expense. Administrative costs recognized and paid, debit deductions, administrative costs for $1,000, see here. Credit cash, $1,000. Should call it administrative benefits. And then they adjust the investment to market value. So they had a $1,200 gain on the investment. So you debit investment in bonds. Because this is a proprietary account, it uses something very similar to financial accounting. So they got mark-to-market accounting. And you're going to credit additions, investment revalued, $1,200. And these additions and deductions accounts are temporary accounts that are going to be closed.